In this section, we'll be discussing about debt financing. So normally debt financing refers to the issue of debentures, bonds, and even sometimes preference shares, because preference shares are paying a compulsory or fixed dividends. So preference shares can also be classified as debt financing. And debt financing can also include short-term debt financing and long-term debt financing. So anything which is not equity can be classified as debt. So what are the factors which influence the choice of debt financing? Okay. So one is availability. Debt financing is usually available for all the companies, but the larger scale of debt financing is available only for large companies. Credit rating. Only when the higher the credit rating a company has, the lower the interest rate. So the higher the credit rating a company has, the lower the interest rate. So that determines the choice of debt. The amount. Usually debt financing is available for a larger amount. Duration. So duration of a debt financing can be even for a period of 3 years to 10 years. But usually debt financing is even available for uh, a month time, from 1 month time to 10 years. But here we are speaking about the debt financing as a longer term source of fund. So that's why we consider 3 to 10 years. Fixed or floating rate. So which rate also determines the debt financing. Security and covenants. So security is a collateral or a pledge or asset that you give as collateral. Covenants refers to the rules and the regulations that the debt finance holders or debt holders imply for the company. So the higher the security, the lower will be the interest rate, and higher the covenants, the lower will be the interest rate. So market conditions. So in favorable market conditions, debt financing is cheap, but in times of crisis, then the debt finance would be much more higher. So so these are the factors which influence the choice of debt. So we'll discuss what's the difference between a long-term debt and a equity. So in long-term debt, we have to pay regular cash payment in the form of interest, but in equity, dividends can be regular or irregular. In terms of debt, there's a legal guarantee to return the amount of money borrowed, but in equity, there's no such compulsion to return the money back and all, because they are partly owners. In debt, high priority is given on times of liquidation. So at the time of bankruptcy or liquidation, debt is given more priority than the equity shareholders. So that's about the liquidation part. Stated maturity date. So when the debt gets matured and has to be repaid is always stated. For example, a 5-year debenture. But no such date is mentioned for equity. There is no voting rights for debt holders, so they can't intervene in the decisions of the company. But equity shareholders have the right to vote on decisions. So there is a positive and negative covenants. So just now covenants refers to the rules and regulations imposed by the debt holders. So there can be positive and there can be negative. For example, positive is the interest coverage ratio should be more than 5 times. So that is positive. Okay. Negative covenants is company should not issue further debt. So no new debt. Okay. So something which says the company should have this is positive covenant. A company should not do this is called a negative covenant. Such rules and regulations are not imposed by equity shareholders. So this is the major difference between a debt and equity. So now we will discuss about the difference between the short-term equity debt and long-term debt. So short-term finance is required to cover the day-to-day expenses of a business. For example, to pay electricity bill, to pay rent, to pay salary. So these are like expenses which are covering the day-to-day expenses or month-to-month expenses. So they are paid back in short period of time. So we borrow this month and next month we can pay these short-term loans. Loan period is usually within a year. So only when it's within a year, it's classified as a short-term finance. Interest rate will be lower for short-term finance. So that is always the nature. So always have this point in your memory. The short-term interest rate will be lower than the longer term. So now we'll look at the long-term debt. So long-term debt finance uh, is used in times of large scale projects. For example, the company wants to construct a new factory. In that terms, what happens is construction of a factory will take a long time. Thereafter only the company will make money. So in such times, the company goes for long term finance. So tends to be spent on large power projects which will pay back over a longer period of time. So for example, if it takes like 5 years of time to construct and make money with the factory, then the company goes for longer term debt finance. But this is like more risky. So the money will be repaid only in 5 years time. So there is a high risk that the company might not pay or the company might fail. So debt holders, what they do is they ask for some kind of a insurance or security. For example, security in the terms like what we saw in covenants or we saw in collateral. Okay, so the company has to comply with covenants or collateral. So as it's more risky, the company has to do these things. The long period loan is more than 1 year. So typically it is around like 1 year to 10 years. That's a longer term debt time period. The interest rate will be higher. The longer the loan, the higher will be the interest rate. A mortgage is an example of a secured long-term finance. So if a company is like mortgaging their assets and they are raising a loan, that is a typical example of a long-term finance. So now we will move on to a quiz. The company is evaluating the advantages and disadvantages of short-term and long-term financing options. Which of the following two characteristics are usually true? Okay, so he's asking which is true. We'll start from this side. Short-term financing. So he asks whether there's a lower rollover risk or a higher rollover risk. First, you'll see like what is rollover risk. Okay, see, you take a 5-year loan and the loan interest is like 10% and the period is for 1 year to the 5-year. The interest rate is constant throughout the 5-year period. But what you feel is rather than taking a 5-year loan, let me take a 1-year loan for 5 times. Okay, that's what you feel. So what happens is this is 1 year, second year, third year, fourth year, fifth year. So will you have the same amount of interest rate? Okay, first time you borrow, it will be like 10%, but next time when you go, it can go to 12%. The next time again 9%, again it can go to 13%, another go to something like 10%. So what happens is there's something called, this is called a rollover. Okay, the closing of one loan and the taking of a new loan, this is called a rollover. So we are making rollovers again and again. So it's something like we make 1 2 3 4 rollovers. So every time you roll over, there is a risk. There is also a gain where the interest rate can go lower. There is also an advantage, the interest rate can go lower, but still there is a risk. Okay, so short term financing have higher rollover risk. So higher rollover risk is correct. But in long term financing, whether the interest rates are low or higher, see, in long term financing the interest rate is always higher. Why? Say assume that you give a loan to a person. Okay, So you give a loan to your friend. You give a 5-year loan and you give a just a 1-year loan. Which one is riskier? In 1 year, that's a good chance he will give you the loan. But in 5 years, you don't know what will happen. His life can change. He can go to a new country, or he can become poor or rich. There's a high amount of risk involved. The risk is always higher in a longer term loan, but the risk is always low in a shorter term loan. Okay, so long term financing will have a higher risk and higher interest, so therefore higher cost. So as both these things are picked, the answer should be B. Let's check. The answer is B. So now we'll move on to the short term financing itself. So as a part of the short term debt finance, we have this topic, overdraft versus short term loan. This again is a very important topic, so ensure that you understand the concept. There are like a lot of points, we'll discuss them. So bank overdraft and bank loan are both given by the bank only, but bank loans are a stable and secure loan. For example, you go to a bank, the bank knows you well, and it also knows your business, so the bank manager will issue you a 1-year loan. So what you have to pay is you just have to pay 10% for the period, and you ask him that you don't want a loan of 10%. You say that I just want a bank overdraft. What is a bank overdraft? Here the bank manager will say you have to open a current account, okay, and whenever the current account balance goes to zero, still the bank will give you a loan. For example, like 1 lakh loan it will give. So with that 1 lakh loan, even if your account is zero, you can still issue check, you can still make bank payments. Okay, so what happens is the bank is giving you again a temporary short term loan, but the loan is used only when required. So here in bank loan, they have given you 1 lakh in hand and it's up to you to spend it. But in bank overdraft, they give you a loan only when your current account reaches zero, and if it wants to go below, they give you a overdraft. Okay, so hope you have understood the logic here. So in bank loan, you have the cash in hand. In bank overdraft, you don't have cash. Only when it goes to zero and below, you can go for a bank overdraft. Okay, so what is the advantage of bank overdraft? It's easier to arrange. It's very flexible. So only when you require a kind of a short term bank overdraft, you are going to get it. Interest is only paid for the amount that is borrowed under the facility. So for example, in a particular month, only 50,000 rupees is required. Okay, so only for that 50,000 rupees, the interest is levied. Then next month, you get only 20,000 rupees loan. Okay, bank overdraft. So only for the 20,000 you have to pay the interest. So it is not secured on the assets of the business. So bank overdraft is given on the basis of goodwill of the person or the company. So these are the advantages of a bank overdraft. We look at bank loan. See, there is greater certainty of funding provided terms of loan are complied. So once you have complied with the procedures, you are going to get 1 lakh in your hand. But the good thing is the interest rate is lower here. Why interest rate is lower is because the bank has given you 1 lakh and it's going to get the money back in a year. So there's certainty. In bank overdraft, the bank does not know how much you are going to get as a overdraft. So they have a risk. They don't know how much you will borrow. Suddenly you borrow more, suddenly you borrow less, suddenly you don't borrow at all. So it's always risky here. So what happens is the interest rate is higher in bank overdraft and lower in bank loan. Appropriate method of financing fixed assets. So if a company wants to buy fixed assets, then they go for a bank loan. For example, the company wants to buy a lorry, the company has to go for a bank loan. So what are the disadvantages of bank overdraft and bank loan? So This bank overdraft is a facility given to the company for its goodwill and for its reputation. So this can be withdrawn at any time. Assume that in a bad situation, you definitely need money. At that time, you go for bank overdraft. The bank would have cancelled it, saying that your reputation is bad. So the time at which you need the money most, you won't get it. So that is the problem with overdraft. The interest rate charge varies with changes in the interest rate. So the interest rate keeps changing as the market rate fluctuates, and it always has a higher interest rate compared to a bank loan. So what are the disadvantages of a bank loan? It requires a collateral. For example, we said we can get a loan on the lorry. The lorry is the collateral. Interest paid on full amount outstanding. You have to pay the interest for the entire 1 lakh. It's a little bit harder to arrange because you have to comply with the rules and regulations of the bank. So this is about the overdraft and bank loan. So now we will move on to a next topic called as the floating charge versus a fixed charge. See, assume that you are going to issue any debenture or bond, you have to give collateral. It's called as security, or it's called as pledge. Okay, either way they mean the same thing. We'll discuss about the floating charge and fixed charge. See, a floating charge is a type of security that a creditor undertakes on entire business assets in respect of a particular debt. Okay, so assume that you give 1 crore to a company as loan, and the company has 10 crore of assets. Okay, the company says you are eligible to take any 1 crore of asset. Okay, but the problem is you never know which asset they will give you in times of liquidation or bankruptcy. For example, if they give you land, okay, which they say is 1 crore, but in market price it can even be 1.2 crore, then you are happy. Or if they say take my all my cars which are worth 1 crore, but what happens is in reality all the car after depreciation and when you sell in the market you will realize only 0.8 crore. So mostly they won't do this. Okay, a company which is liquidating won't do this. What they will try to do is this. So there is always a problem in floating charge, as they are not specifying you the asset. You don't know which asset they will give, and the asset's worth can be lower than what it is stated. So that is the problem with the floating charge. What are the advantages of floating charge? Floating charge can be created even when the company does not have any fixed asset. For a company's point of view, these are the advantages. They can say we offer you collateral, but they won't say which asset. It offers a lot of freedom to the business owner, so he can just simply make a promise. A floating charge holder is always better protected than an unsecured creditor. So the position of a debt holder who has a floating charge is always better than to be a unsecured. Unsecured is he don't have any security over the assets for his loan. So for compared to that unsecured creditor, floating charge is much better. But still, if you have a fixed charge, that's a great. A fixed charge is a charge or mortgage secured on a particular property. So you give a 1 crore loan and you say you are securing this loan with a machine, a particular machine. Okay, the machine worth is around 1.2 crore, and you feel that even when you sell it in the market, you will still get the 1 crore. Okay, so what happens is both the parties are happy. The company which gives the loan is happy because they have a security to 1.2 crore. The company which gets the loan is assured that even when the machine is sold, they will only get 1 crore. So both parties are happy in a fixed charge. Okay, so it is always made on a particular property such as land and buildings, a ship, a piece of machinery, shares, intellectual property, on copyrights, patents, trademarks. Okay, So fixed charge is on a particular asset. So please remember this. And we can also say like this, a floating in terms of interest rate, the floating charge holder will get a higher rate of interest, and a fixed charge debt holder will get a lower rate, because the risk is higher here, the risk is lower here. Okay, so interest is always linked with the risk. So we'll move on to the convertible bond versus a simple bank loan. So what is a convertible bond? So a convertible bond is a combination of equity and liability. A part of the loan is a conventional or a normal loan, and the other part is the right to buy shares. Okay, call option to shares, or we can say the right to buy shares. So it has two elements, loan element and the right to buy shares element. So what are the features of convertible debt? Convertible debts are instruments that can be converted into equity shares of the company at a future date. These securities have the feature of debt and equity. It pays a periodic interest rate just like any other debt instrument, but the interest rate payment is lower compared to a normal debt, as there's an option to convert to equity shares. At the time of redemption of bond, the investor can choose to receive the shares of the company instead of cash. So at the fifth year end only, you will get that option to convert into shares or just have it as debt. So we'll discuss about the convertible loan versus a bank loan. So in a normal bank loan, okay, in a bank loan, what you do is you want to borrow 1 crore of money, okay, at 5 years, and you pay an interest of 15%. Okay, this is one option. So how much do you pay? You pay 15% every year, and the loan is for 5 years. Now if you go for a convertible loan, okay, you go for a convertible loan, the same 1 crore, and it's for the same 5 years, but what would happen is the interest rate will be only 10%. So why is the interest rate 10%? Because as a convertible loan, the convertible loan holder has two incomes. One is the interest, which is 10%, and the other is the convertible option. Okay, so what happens is the company makes a promise. The promise works like this. The loan, okay, the loan of, for example, a loan of 100 rupees can be converted into 10 shares, okay, at the fifth year end. Okay, at fifth year end. So this is the option they give you. So now we will work out the option. Assume the price today, okay, the price today, we will put it as current market price. The current market price is 10 rupees per share. In the fifth year, we will close the game. In the fifth year, you have an option, okay, you can have an option to convert or don't convert. So what would happen? See, the shares that have been given to you, okay, the 10 shares, at the end of the fifth year, you have an option. You can convert your bond to shares. So on the date of conversion, the number of shares that you get is 10, and the price at which it gets traded is 20 rupees. So it is not the 10 rupees, it has now become 20 rupees. So you will be ending up with 200 rupees for every 100 loan note that you had on the debenture or bond that you had. Now their worth is 200 rupees. Will you convert or not? The answer is yes. If The again at the fifth year end, you have the right to get 10 shares, but the shares are traded at 5 rupees per share. Now will you convert? If you convert, you will get only 50 rupees. The bond itself is worth 100 rupees. Will you convert? The answer is no. So the company gives you an option at the fifth year end either to convert your bond into shares or not. If it's favorable, you will convert. If it's not favorable, you won't convert. As the company is like allowing you to become an equity holder, they give you the lower interest rate. So the lower interest rate is because it's 10% plus an option to buy shares. As you have that option, the interest rate is lower. Okay, so that's the reason why bank loan interest is much more higher than convertible loans. So hope you got a good idea about the topic. So now we will compare both convertible bond and bank loan in terms of risk and return. Which one has more risk? See, the risk is lower in terms of debt. For example, in terms of secured debt, risk is lowest. Okay, the risk is lower, but risk is higher in terms of convertible bonds. Okay, so as the risk is higher, so it works like this, it goes from lower to higher. The risk is higher in the bonds, the interest rate is given at 10 plus there's an option. Okay, so only when it's much more attractive, you will get people to invest in the convertible bond. So you'll go for a quiz. So for what reason would a firm issue a convertible debt? It is cheaper to service than ordinary debt. Yes, this can be an answer, but we'll still wait. Sales and earnings are expected to fall over the next few years. No, sales and earnings are expected to rise. That will cause the share price. To rise. So this answer is fully wrong. If conversion takes place, it will not change the firm's gearing. If conversion takes place, then equity shares are issued and the gearing will change. So the word not is wrong. If conversion takes place, it will generate additional finance for the firm. No, the finance has already been generated. The company has to either give equity shares for free or it has to pay them. So this option is wrong. So option A should be the right one. So option A refers to interest payment. So we'll start with the sale and lease back. Assume that you own a hotel and the hotel is worth around 10 crores, and with that hotel you make 1 crore as profit. Okay, every year you make 1 crore of income from that company. So now what happens is you feel that rather than having the hotel by yourself, you try to sell it. If you sell it, you will get 10 crore as cash. But as you have sold the hotel, how can you run the business? So you ask the same buyer, okay, you ask the buyer to lease it. Now you will pay 0.5 crore as lease every year, either as rent or you lease it. So assume that you lease it for 0.5 crore. Now what happens? Now you will get the same income. The income will be the same 1 crore, but you pay a lease of 0.5 crore every year. So your income after lease would be 0.5 crore. But still, what happens is you have taken the 10 crore cash is received. With this 10 crore, you can put it in further business. Okay, and you can make money. That money will be getting added to the 0.5 crore income. So this is called as sale and lease back. Sometimes you don't even need to pay a rental. What happens is you can take a 20-year lease. Okay, in that case you just pay a fixed amount to them. For example, in a lease, what happens is they don't pay you for the 10 crore that they pay. You can give them 2 crore as lease amount, and you can just use the building for 20 years. So even that is possible. A company which owns its own premises can obtain finance by selling the property to an insurance company or pension fund for immediate cash and renting it back, usually for 50 years, with rent reviews only for a few years. So you first sell it and you then rent it or lease it. A company would raise more cash in the form of a sale and leaseback arrangement than a mortgage, but there are significant disadvantages to this model. The company loses the ownership of a valuable asset. The future borrowing capacity of the firm will be reduced because you can't, once you have got the cash, you cannot say that you can mortgage the building as a collateral because it is already sold. The company is contractually committed to occupying the property. So if it's going to be a 20-year lease, there's no other way, you have to be there for 20 years lease. There will also be frequent rent revision. So the rent can also be increased periodically. So these are the problems in a sale and leaseback method. So now we will discuss the relationship between the bond yield and the price. So there are three parts to a bond: the issue price, the interest, the redemption value. So for the sake of explanation, we can see like this. The bond was issued at a price of 100. The company pays a 10% interest rate, so that is 10 rupees per year. The bond is again bought at 100 rupees at the end of 5 years. So it's a very simple and straightforward bond. Once a company has issued the bond, it receives 100, then it pays 10 rupees as interest periodically every year, and it needs another 100 to redeem the bond at the end of 5 years. Now, usually the bond will be issued at a market interest rate. So the company has issued the 10% as that is the market rate. Okay, so you can't say that I will issue my bond at 5%, 10% or 20%. You will issue at the market rate. Okay, so assume that the market rate is 10%. You will not issue a bond at 20% because that is a loss for you. You won't issue at 5% because no one will buy your bond. You have to issue at 10%. Okay, so that's how the interest rate is fixed for a bond. If it issues a 9% bond, okay, again we have the same example. If we issue it at a 9%, no one will buy it as the market wants 10%. Company will not issue at 11% because it is unnecessary cost for the company, as market itself wants only 10%. So we will see the bond yield and price. The bond buyer can sell the bond in the market at any time before the redemption date also. So once someone has bought a bond, they can sell even before the redemption date. But the price which he tries to sell depends upon the interest rate that the market wants. The coupon interest rate of the company is fixed. So the coupon interest rate is, the interest rate of the company is only 10%. So they will pay only 10 rupees per year. But the market rate keeps fluctuating. So what happens is, so the price of the bond changes according to the market rate it wants. For example, we look at this picture. If the company has issued 10% bond, the interest is 10. So the price of the bond is based upon 10 rupees interest divided by 10%. The price of the bond comes to 100. So that's how this calculation comes up. If the market interest goes to 8%, if the market wants just 8%, the interest from the bond will always be 10 because that is what was promised. If you have the bond, you will get 10 as the interest. But what would be the price of the bond? The price of the bond would be 10 the interest amount divided by the market rate is 0.08. So what would happen is the bond price will automatically go to 125 rupees. Why? Because at 125 rupees, if the market wants 8% return, the interest is comes to the same 10. Okay. So the dividend number will always determine the price of the bond. So we look at 10%, 12% now. The interest rate paid by the company is same 10, but the divider will become 0.12 or 12%. So the price of the bond comes to 83. Okay. So you can calculate what would be for this and this. So the price of the bond keeps moving accordingly to the market interest rate. So the price of the bond will not stay constant. That is the rule. So hope you have understood the concept here. We can also see it as a picture. So you can look at this. Assume that the company has issued the bond at 9% interest rate. Okay. As long as the interest is going up like this, in this case, the bond price falls down as the interest goes up. Okay, market interest rate goes up, the bond value falls, and as the bond value falls, the price of the bond goes up. So you can put like this: the bond yield and the price are inverse in nature. Inverse in nature. So that's what this chart also shows you. This is the interest rate and this is the value of the bond. So that's how it moves. Okay, we have a question here. This is a very important element, the price and yield. So there's a question. In relation to an irredeemable security paying a fixed rate of interest, which of the following statement is correct? As risk rises, the market value of the security will fall so that investors will receive an increased risk yield. So as the risk rises, okay, if risk rises, interest rate will also rise. So in this terms, as risk rises, interest rate also will rise. If interest rate rises, what is the relationship with the price? The price will go down. So as risk rises, the market value of security will fall. So that investors will receive an increased yield. This is correct. So this is the correct option. So other options are just distractors. So we don't need to read them. And thankfully, if the right answer is at A, you can easily get the answer. If the answer is going to be at D, you will get confused with B, C, and things like that. And finally, by the time you come to D, you will get thoroughly distracted.